with that, my portion of the presentation is done. I'm going to hand that over to Tom Briney, who will introduce himself and then talk about both Trinity Place and then the Cherry Creek Plaza 1 and 2. So Tom, handing it off to you. Thank you.
Thanks a lot, Michael. As Michael mentioned, my name is Tom Briney. I've been with Origin for about 6.5, 7 years, and I've been investing in commercial real estate at an institutional level for a little over 11 years. I'm responsible for deal sourcing and acquisitions in both Denver and Chicago. First deal I'd like to talk about a little bit is Trinity Place. It's a 115,000 square foot Class A office building located in the West Raleigh submarket in North Carolina. This acquisition was a little bit unusual for us in that it was 100% occupied at acquisition. It really required very little capital for us to maintain the quality of asset that we were acquiring. The reason we liked it and we decided to invest in it is because of the proven demand both in the submarket and in this asset. If you look at the average occupancy in this building since it was built in 2000, over the past 16 years, the average occupancy was 94%. On top of that, in 2008 and 2009, in the heart of the downturn, occupancy was 97%. That really speaks volumes to both the asset, the location, and the quality of the tenants that are inside the property. They're all financially sound and strong and had the wherewithal to survive the downturn when a lot of companies didn't have that ability to do. Additionally, the property is generating tremendous cash flow. Year one dividend is expected to be about 16% based on the contractual cash that's in place today and at acquisition. And then over our 6-year anticipated hold, we're still generating a double-digit cash dividend to investors. That's extremely unusual, and we found that very attractive. So the bottom line for this particular deal is we feel like there's very little risk being taken for the outsized returns that we're generating. Let's jump to Cherry Creek for a minute, which is located in Glendale, Colorado, just outside of Denver. It's an extremely infill market with a tremendous amount of amenities nearby, including shopping, retail, and outdoor amenities. This was a deal, as Michael mentioned earlier, that we had spent about 16 months trying to acquire and making sure that we had the pricing and the structure just right. And the reason it took that long, in addition to trying to make sure everything was just right, is that it was an off-market transaction. There were no other parties trying to bid on this, and we were able to achieve exceptional pricing as a result. To put that in perspective, the price that we paid for this building was between 30 and 40% below where the competitive properties have traded in the past 12 months or so. In addition, it's about 65% below what it would cost to replace the same building today. So when you start off with a low basis like that, it gives you a tremendous amount of flexibility to be successful with your investment. The reason it struggled early on and the reason we had the opportunity to invest in this deal is because, as Michael mentioned earlier as well, it was really struggling with a lack of cash from the current investors. They didn't have the ability to put in the cash, and therefore they fell behind from a market and a leasing perspective. So we're coming in with operational expertise as well as fresh capital. And we believe that with this fresh capital, we'll be able to increase our rents to where the market's at today or perhaps exceed it. And looking at the competitive set, we believe that our in-place rents are more than 20% below where the competitive set is at. So once we've invested the capital, the additional capital into the building, and we've executed our operational expertise, we should be able to push rents in excess of 20%. This is more the bread and butter of what Origin invests in. And as Matt will tell you here in a minute, we see a lot of deals that fit this profile, and we invest in a few of them that make a lot of sense. And so with that, I'll let Matt talk about a couple of different opportunities and tell you about himself.
Thanks, Tom. My name is Matt Ozzie. I'm a Vice President of Acquisitions. I'm located in Dallas, and I'm responsible for Origin's acquisition activities in Texas. The first opportunity that I want to discuss today is the AMLI Medical Center. The AMLI Medical Center is a Class B multifamily asset located in Houston, Texas. It was originally built in 2000 and comprised of 334 individual units. And, you know, the first thing I really want to address here is anytime that anybody mentions Houston, the first reaction is, and thought process is the energy business. And to be honest, that's really no different for the majority of real estate companies that are out there today. But I want to tell you a little bit why we think they're wrong and why we view this opportunity a little bit different. First, since a lot of our competitors are unwilling to spend any more time sourcing new acquisitions in Houston, we were able to acquire this asset at a discount to where it would have traded 2 years ago. And while we love buying right, it allows us to implement our value add program at a very competitive rate. The most and greatest competitive advantage for this asset is really the location. The location is the asset's located in the Texas Medical Center. And for those who don't know, the Texas Medical Center is the world's largest medical complex. Employs over 100,000 people. And not only is it the largest, it's currently expanding with over $3 billion earmarked for expansions and renovations. And the reason why this is important and why it relates to our asset is, this asset is at the doorstep and in the medical complex with a high walkability, and it will continue to provide high demand from renters wanting to live near where they work or study. For context, over half of our renters at acquisition were employed or were studying at the Texas Medical Center, and roughly only 5% of our residents were tied to energy business at all. So it's very well insulated from any ups and downs that the energy business may have now or in the future. And we actually believe and foresee that being the case through our hold period. The last thing I really want to touch on this asset is due to the increased land prices and the new city design requirements from Houston, this type of property will not be replicated in this location. And so we're able to provide a unique setting for our current residents as well as future residents, which will help provide high demand going forward. Moving on, the next asset I'd like to talk about is Lee Park Towers. Lee Park Towers 1 and 2 are Class B office complex comprised of 2 buildings that make up about 120,000 square feet. The first asset was built in the 60s, and then the second asset was built shortly after in the early 70s. This opportunity is one we're very excited about, mainly because this is the best located office value add opportunity I have seen in Dallas in the past 2 years. And the reason why the location is great, it's located in the Turtle Creek Uptown submarket. For those who are familiar with Dallas, I mean, it is the premier work, live, play submarket in all of Dallas and Texas. And, we were able to source this acquisition off market. And the reason why is we had extensive knowledge about the previous ownership's personal situation. The previous ownership was comprised of approximately 20 different oil and gas professionals who had been unwilling to spend the necessary capital to upkeep an institutional quality product for the last 2 years. And then they arrived at a situation where they needed to sell to improve their own liquidity. And so due to their need, and over a 6-month period, we were able to negotiate an acquisition price that was approximately what the land value would sell alone at today. And to get an idea on that is, we believed we had a good asset, and when it went to be, appraised from a third-party vendor, the asset actually appraised for more than $3 million what we have it under, what we paid for it. And so the reason why it's so important is that allows us to implement our value add program, which you've heard Tom and Michael speak about previously. So for this asset, we're going to spend over $3 million to renovate and increase the overall appeal of the property. And even though we're spending $3 million, we're able to still provide some of the lowest rents in this premier submarket, which gives us a huge competitive advantage for prospective tenants when Dallas is seeing all-time highs in rents. And just for some context here, we closed on this acquisition on August 31st, and our returns that you see in the slide here of 17% assume $26 pro forma rents. And since acquisition, we've actually already signed and executed a new lease at $35 per square foot and have multiple other offers that we're negotiating at $28 per square foot. So we believe we underwrote this conservatively and will possibly outperform our projections. With this said, I'd like to kick it back to Michael.